Welcome to the Deep Dive. Today, we're jumping right into Chewy's Q2 2025 financials. What's the real story behind the numbers and the market reaction?
Exactly. We're looking at the results and, maybe more importantly, the forward guidance they just announced today, September 10th. We want to pull out the key insights for you.
Okay, let's get straight to it. Chewy's Q2 results are out. Top line first net sales hit $3.1 zillion.
Yep, and that's up 8.6% year over year. What's notable is that they actually beat their own guidance range.
A solid beat. But then you look at the market.
Right, and that's the puzzle, isn't it? Despite beating on revenue and meeting the adjusted EPS forecasts, the stock took a big hit.
Over 14% down on the announcement day.
Yeah, and it was already down almost 10% in pre-market. It really suggests investors are maybe more focused on the outlook, the guidance, than just the past quarter's performance.
Okay, so strong Q2, nervous market. Let's look closer at those Q2 numbers, though. Adjusted EBITDA.
Came in at $183.3 million. That's a 5.9% margin.
Which is a healthy jump, right? Like 26.5% year-over-year increase.
It is. And adjusted diluted EPS was $0.33, right on the money with forecasts. So operationally, Q2 looked pretty strong on paper.
So what's driving that strength? If the market's worried, the current numbers must have some power behind them.
A huge driver, and it's consistent, is Autoship, their subscription program.
Ah, yes, the recurring revenue engine.
Exactly. Autoship sales were $2.58 billion. That's 83% of total net sales this quarter.
83%.
And it grew almost 15% year over year. It's this massive, sticky customer base providing predictable revenue.
And that stickiness seems real. Customer numbers are up too.
Yep, they finished Q2 with 20.9 million active customers. That's up 4.5% from last year.
Okay, more customers. And are they spending more? That NSPAC number, net sales per active customer.
Good question. It grew to $591, so up 4.6% year over year. Customers are spending more on average.
So is that just inflation, or are people buying like more stuff or more expensive stuff from Chewy?
It seems to be more than just inflation. Diving into the profitability side, their gross margin expanded. It hit 30.4%.
Up 90 basis points year over year. So almost a full percentage point better.
Right. And management actually called this out as the high point for the year on gross margin.
And why the improvement?
They pointed to a few things. Shifting product mix, more towards premium items, the scale benefits of Autoship kicking in, and also their growing sponsored ads business, which has good margins.
Got it. Now, we should quickly touch on the official GAAP net income. It was $62 million.
Yeah, which looks like a big drop compared to last year.
But there's a specific reason for that, isn't there?
Exactly. This is an important context. Last year, in the same quarter, they had a big one-time tax benefit release, about $275.7 million. So this year's lower GAAP number isn't really about weaker operations.
Right, it's an accounting thing, not a business decline thing. That's why looking at adjusted figures like EBITDA helps sometimes.
Precisely. And talking about real results, how about cash flow?
Good point. Free cash flow for Q2.
It was $105.9 million, and they used some cash, $123.6 million, to buy back shares.
And how's the balance sheet look?
Pretty solid. They ended the quarter with $592 million in cash and equivalents, and importantly, zero debt.
No debt. That gives them a lot of flexibility, especially with what they're planning next.
Absolutely. They're clearly using that strength to make some big strategic bets.
Like Chewy Plus, their paid membership. How's that doing?
It's gaining traction quickly. They said it was already about 3% of total monthly sales back in July.
So still small overall, but growing. What's the pitch? Why join?
Well, it's $49 a year after a trial. You get free shipping, 5% back in rewards, some exclusive deals. But the key thing they're seeing is what they call incrementality.
Meaning members actually buy more.
Exactly. They buy more often, they add more items per order, and their NSPAC, that spending per customer, grows faster and higher than non-members. They want it to be like, the Amazon Prime for pets.
The indispensable pet membership. Okay, that makes strategic sense. What about new products? I heard about Get Real.
Ah, yes. Their new private brand. It's a line of fresh dog food.
Fresh food, like human-grade ingredients.
Yeah. Think chicken and Brussels sprouts, beef and sweet potato. Pre-portioned, delivered. It's exclusively an Autoship subscription business.
Interesting. High margin potential, I imagine, but also complex logistically.
Definitely complex. But they're betting big on it. They've built capacity through 2028 already. It taps right into that premiumization, humanization trend in pet food.
Are they attracting new customers with it, or is mostly existing Chewy users upgrading?
It's a mix, but encouragingly, about 30% of Get Real customers are completely new to Chewy. 70% are existing.
And these customers spend a lot more, right?
Significantly more.
Yep.
The NS pack potential is over $800 a year just for toppers,
Hmm.
additions to regular food, and it jumps to over $2,500 a year for customers using it as the full meal.
Wow, that's serious spending. And the market for fresh pet food is expected to grow quite a bit.
Hugely. It's around $3-4 billion now, projected to hit maybe $8-12 billion in a few years. So Chewy is planting a flag in a fast-growing, high-value space.
Okay, so Chewy Plus for loyalty, Get Real for premium food. What else? Chewy Vet Care.
Still outperforming their expectations. Those vet clinics are driving the highest and fastest-growing NSPAC curves they have.
Highest spending customers are the ones using the vet clinics. That makes sense.
It really shows the power of that ecosystem approach. They plan to open 8 to 10 more clinics this fiscal year, getting close to 20 total by year-end.
And they haven't forgotten about regular stuff like toys and beds,
Yeah.
hard goods.
No, that segment's recovering strongly, too. They said it's mostly volume-driven growth, helped by having more products in stock and adding over 1,500 new brands.
And they bought extra inventory.
Yeah, they mentioned investing in Q2 inventory for hard goods, partly to get ahead of potential tariffs later in the year, and also to allow for some strategic pricing moves.
Okay, lots of investment, lots of initiatives.
Yeah.
Let's talk about the outlook, the guidance. What are they telling the market now?
So they actually raised and narrowed their full-year sales guidance. They now expect between $12.5 billion and $12.6 billion for fiscal 2025.
Which is about 7% to 8% growth year over year if you adjust for the extra week last year.
Correct. It's a decent $175 million bump at the midpoint compared to their previous guidance. So they feel good about sales.
But, and here's probably the catch for the market, they didn't raise their profit margin guidance, did they?
Exactly. Despite the higher sales forecast, they're keeping the full-year adjusted EBITDA margin outlook the same, at 5.4% to 5.7%.
Meaning all that extra expected revenue isn't flowing straight to the bottom line. They're planning to spend it.
Precisely. It signals a clear strategic choice. Management literally said they plan to remain on the offense and invest to strengthen their market share.
Investing in Chewy Plus, Get Real, vet care expansion, maybe pricing.
All of the above, likely. So less immediate profit expansion, more focus on long-term growth and capturing the category. That can make short-term focused investors nervous.
How are they managing costs then? SG&A selling, general, and admin expenses.
Well, Q2 saw a bit of deleverage there, meaning costs grew a bit faster than sales, but they explained it.
Why was that?
Two main reasons. Ramping up the new Houston fulfillment center, which takes like 6 months to become efficient, and those temporary higher costs for bringing in inventory early to handle tariffs and pricing.
They expect that to improve.
Yeah, they expect SG&A leverage costs growing slower than sales in the second half of the year. Their overall plan is for 60% of the year's margin improvement to come from gross margin and 40% from managing operating expenses better.
So, bigger picture.
Yeah.
What's their view on the pet market itself? Is it still growing strongly?
Their view is that pet household formation, new pets, will be sort of flat to maybe slightly up this year.
Okay, so not huge growth in the number of pets overall.
Right. And the industry as a whole growing at low to mid-single digits. But Chewy expects to keep growing faster at that 7% to 8% rate, meaning they're continuing to gain market share.
And their formula for that growth remains the same.
Pretty much. Keep active customers growing low to mid-single digits and keep NSPAC, the spending per customer, growing mid-single digits. Acquire customers and get them to spend more over time.
Makes sense. Now, we've used terms like adjusted EBITDA and adjusted EPS quite a bit. Maybe a quick reminder for listeners on what those non-GAAP measures mean.
Sure. It's important. These are non-GAAP figures, meaning they aren't calculated using the standard generally accepted accounting principles. Companies use them to show underlying operating performance.
By excluding certain things, right?
Exactly. Adjusted EBITDA, for instance, typically excludes interest, taxes, depreciation, amortization, and often share-based compensation, things that aren't direct cash costs of running the day-to-day business.
So they can be useful for seeing operational trends.
They can. Management uses them. Investors look at them. But they have limitations,
Right. They don't show everything. Like they don't reflect the cash needed for big investments like building those fulfillment centers or vet clinics.
Or the cash needed for working capital, just to keep inventory flowing and operations running. So you always want to look at them alongside the official GAAP numbers, like net income, to get the complete picture.
It's like looking at different gauges on the dashboard. You need them all.
Absolutely.
Okay, so wrapping this up, we've seen Chewy deliver a solid Q2, strong Autoship loyalty, and they're pushing hard with investments in Chewy Plus, fresh food with Get Real, and vet care.
Definitely playing the long game. Building out that comprehensive pet ecosystem, even if the market reacted a bit nervously to the near-term investment levels implied by the guidance.
They seem confident they can keep taking share in a relatively stable market.
That's the bet, leveraging that customer base and expanding their services.
So here's something to think about. In today's market, everyone wants quick results. But how much is it truly worth, long-term, for a company like Chewy to aggressively invest now to lock down customer loyalty and spending in a stable category like pets, even if it means profits don't jump immediately?
It's a fundamental question about investment horizon, isn't it? Are you betting on the quarter or the decade?
Definitely something to chew on.